Have you ever wondered how the Basel III regulations are reshaping the global financial landscape? This ambitious set of international banking regulations, developed by the Basel Committee on Banking Supervision, is now in its crucial endgame stage, a period that promises to bring significant changes to the banking sector and the wider economy. Basel III aims to bolster regulation, supervision, and risk management within the banking sector. It introduces higher capital requirements, stricter risk assessments, and new liquidity and leverage standards. The ultimate objective? To boost the banking sector's capacity to absorb shocks from financial and economic stress, thereby mitigating the risk of a banking collapse akin to the 2008 financial crisis. However, every coin has two sides, and Basel III is no exception. One of the major concerns is that the new regulations could inadvertently impact small businesses and middle-class borrowers. As banks tighten their lending criteria to comply with the new capital and liquidity requirements, these groups may find it increasingly difficult to access credit. This could potentially hinder economic growth and innovation, especially in sectors heavily dependent on external financing. Moreover, the gradual implementation of Basel III has sparked debates about the pace of its rollout and its effectiveness in addressing the inherent risks in the financial system. Critics contend that the slow pace allows banks to incrementally adjust their strategies, which could potentially dilute the impact of the regulations and perpetuate vulnerabilities within the system. Coinciding with the endgame of Basel III is a broader shift towards digitalization and the growing influence of non-bank financial institutions. This evolution raises further questions about the scope and reach of the regulations, as new financial technologies and platforms emerge that fall outside the traditional banking framework. In the midst of these challenges, the concept of sound money has gained renewed attention. Physical assets like gold and silver, unlike digital or fiat currencies, offer a tangible store of value that has stood the test of time. This has led some to advocate for a return to more traditional forms of wealth preservation, especially in times of economic uncertainty. So as we traverse the endgame of Basel III and gaze towards the future of global finance, it's clear that a delicate balance must be achieved. Robust regulatory frameworks are essential for maintaining financial stability and preventing future crises. Conversely, policies need to be flexible enough to adapt to the rapidly changing financial landscape and support sustainable economic growth. Navigating this path will require careful consideration of these competing priorities, with an eye towards constructing a more resilient and inclusive financial system. In conclusion, navigating the endgame of Basel III involves striking a balance between maintaining financial stability and fostering economic growth. The implementation of these regulations presents both opportunities for enhanced financial stability and potential challenges, including restricted access to credit for small businesses and middle-class borrowers, and the ability to adapt to a rapidly changing financial landscape. As we move forward, the role of traditional forms of wealth preservation such as gold and silver, and the need for flexible policies that can adapt to the evolving landscape, come to the fore.